day all. Ira Epstein of Linn Associates with your agriculture update, and this is for Tuesday, the 27th of August, 2019, about 3:10 in the afternoon. That's p.m. Central Daylight Time. Well, a basic down day in the grains. They still keep falling, if you will. Got a little bit of a rally today in the energy markets is the idea that President Rouhani threw out of Iran. Well, the U.S. should first drop its sanctions, then Iran will talk. Yeah, that's going to happen. So that gave the lift back to this market. Bonds and notes, you're still having inversion. That's on the yield curve. You're still having worries. People still talking. Are they concerned about recession? And you have a stock market break. What's the most important thing right now? You're 3 days away from Friday, which we not even open on Monday, the Labor Day holiday. I'm telling you, the markets are thinning out. I saw stock market volume down about 15% today. I'm guessing it's even worse in the futures at this point. It's a guess. In the soybean market, if you look at a weekly area chart of closes, you can see almost the visual pattern of a high with lower highs and lower lows. Now on this chart, this pattern is often called a falling wedge. And a lot of traders think that what happens is as you're getting lower highs and lower lows within the pattern and not taking out previous lows and settling under it, the market's running out of downside momentum. That's the theory. I'm not saying I buy into it or not. When I look at the swing line here, what I need to negate the downtrend is taking out 870.5. That will break for me the pattern of lower highs and lower lows. Now, 870.5 is over here on this chart, so it's not yet over that downtrend line. That's something I wanted to point out. If you get over 870.5, the question is, can you close over 872.25 to really put the downside bias to bed? In other words, it would become neutral to upside bias. But right now, the bears control the market. Where's the support? Literally right under you at this 853 3/4, 854 level. So let's go back here and take a look. We're not too far from that 854 level right there. Just giving you ideas as to what I'm seeing on the charts. In terms of momentum, oversold. So I have a market that's worked itself down into a possible support zone. The market is oversold, the trend down, the bias down. In the meal market, you still have the lower highs, lower lows. You went right to the lower Bollinger Band and could not push through it today. You tried. You got, in fact, to 294.60 underneath it at 295.10, but then you came back to finish around 297. Soy oil is now very oversold. It's been playing at the 100-day average. I realize it closed under it, so it has a choice. It either pulls back into it to, if you will, test that zone out again, or if it accelerates to the downside, maybe it goes to the lower band. There's certainly nothing bullish on the chart. If you were to take out 28.98, you could negate the downtrend, but there's nothing here that can turn it that I see into an uptrend. In the corn market, as long as you keep the embedded slow stochastic, and this is the difference. If you look at these stochastics, both the blue and the red line, they're not under 20, they're not under 20. But here they're just drifting sideways under 20, right? That's called embedded, it's locked in. And when it embeds, it often means that prices want to work lower and that rallies in them are often sold by the pros. Lose the red line over 20, and I changed the opinion, and I think you're going back to that line in the sand, the 18-day average of closes, but I don't see that right here. So I'm still seeing lower highs, lower lows with a general bearish bias. In wheat, we keep playing around the zone of the 18-day average of closes. Momentum in the Chicago wheat is now in oversold territory. You have a pattern of higher lows, higher highs. The bias is down because you're under the 18-day average, so those two neutralize each other, and you have an oversold condition. In the sugar market, we just said yesterday, if the market's going to pursue another break, maybe it can get to the lower Bollinger Band. Well, did it today. So you still have the pattern of lower highs, lower lows. You've hit the downside target. Doesn't mean the market has to stop there, but often when you hit that band, you're in a zone if you're not in sideways action. None of these were sideways action, so you see how you did get bounces back into it. We'll see if that happens tomorrow. In the coffee market, you keep bucking up against the 18-day average of closes, you have now worked, past tense. You're no longer in oversold territory. You've worked your way out of it. You have the bias down, the swing line up. You need to close over 98.50, actually 98.20. I'll take that back, the 18-day average, to turn the bias up and possibly put into play 102.20 to 102.64. But first, you got to get over that 18-day average on a close, and that's a lot of resistance. I'm going to call this chart neutral. In the cocoa market, we had a bear market rally that is failing against the 18-day average of closes. You have a lower low, higher high pattern. I don't have a trend at work at this point. I have momentum pointing up. And if you take out today's high and close higher tomorrow, then I can turn around and say higher lows, higher highs. We're not at that point. In the cotton market, cotton got back, and each time it's been hitting this 18-day average, I think you'd agree it's failing. Happened again today. Now you went to the Bollinger Band bottom, and you have a little difference here. Notice how narrow these bands are getting. It's a sign that you got to be careful. Something's going to break out one way or the other. In the cattle market, we have a pattern of higher lows, higher highs. However, the market is staying under the 18-day average, so the two negate each other, and you're oversold. In the feeder cattle, you have a pattern of lower highs, lower and low. We don't know where this low is yet going to end up. It's closed today, but it can still drop lower on this move. So the bears still have control, and they've been defending this 18-day average of closes, as I'm calling it. Momentum, pretty flat in the market. I'd say the bears still have control. And in the hog market, we're in a correction phase where the market got oversold. It's correcting it. Resistance, the 18-day average of closes, lower highs, lower lows, hit the downside target is the way that I'd sum that up. You know, one of the things you see me talk about a lot to you are technical indicators. And we have volumes 1 and 2 that were put together years ago with our good friends at Modern Trader. And I updated all this with their help and with their past editors and so on, and this is a legacy, and I think it's the greatest product for technical indicators, easy to read, full color, pictures of all of them, and it's sent to you as a PDF. So if you want to print it out, you've got it, and what a great way to learn about these and get some ideas, and you get quite a bit of them, as you can see. How do you get this? And it is free. Either go to our website, www.iraepstein.com. You'll see free offers. Just click it. Call us at 866-973-2077, or simply click right up here. It'll take you to our free offerings. I'm Ira Epstein. You have a good day.